The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the October issue of Digging into the BI. This is where members from the DC Regional Chapter and the Maryland Chapter get together and be able to look at the latest issue of the member-only magazine, the BI magazine. And here are the four stocks we're going to be looking at tonight. It's going to be Paycom, Schlumberger, Weston, and Brown & Brown Insurance. So we're glad you're here. I see a lot of regulars in the audience. Glad to have you. If you're seeing us on YouTube and you don't know who Better Investing is, hang on, we'll tell you all about it. Let's go to our next slide, please. So here's the standard disclaimer that we use in the Better Investing community. These are for educational purposes. We believe, as Better Investing does, that that you should conduct your own review and analysis. We will try to tell you if our clubs or if we own any of these stocks that we're presenting tonight. And if we do show you anything, we're not any websites or locations that we use to help evaluate our stocks. The presenters are not endorsing or promoting those websites. As always, please do your own research. This is being recorded and it will go up on YouTube hopefully later on tonight or tomorrow morning. Next slide, please. So again, I see a lot of regulars, so I assume you're all BI members, but for those people that are seeing us on YouTube, here's BI, and you'll see at the top of every one of these slides, you'll see betterinvesting.org. That's the location for it. But the overall organization is an investment education organization. That's that blue underline under one at the bottom. And again, if you're here tonight and you have this, make sure to get the handouts. On all those blue underlines are hyperlinks that you'll be able to go directly to that location. And you can share these slides with members of your club or people that are thinking of joining your club or people that you want to get involved in long-term investing. And that's the type of investing we do here at Better Investing, is we focus on long-term fundamental investing. And again, there's a hyperlink to some of the things to talk about it. All of us that are speaking here tonight, we're all volunteers in Maryland, DC, or Virginia. None of us are professionals in this. We do this because we enjoy it. So next slide, please. So here we are up on YouTube. You can be able to find us there. Again, if you just get to YouTube and you hit Digging into BI, you will find us. We have 182 subscribers, so we're clearly not the key folks that have several millions of it. We're trying to get over 200. In return for this free education program, we're asking that take a look at this video. Go ahead and like the individual video. Please share the video with some friends and subscribe to the channel. That's how the algorithm works over at YouTube, which is owned by Google. And you see over on the right-hand side in the blue box, each of these webinars, they're organized on YouTube into chapters so that you can just advance to the particular presentation you wanted to hear. So you don't have to listen to all of them if you only wanted to listen to one. Next slide, please. So again, again, we haven't had this in a while where we've had to troubleshoot. But if you are having trouble hearing us, the usual culprit is that you set it up for a phone call and you're on your computer. But if you have any troubles with that, there's again a hyperlink for it. And that green arrow will take you to where the handouts are. So please make sure during the course of this hour and 15-minute presentation to download the slide deck. And we have 4 completed SSGs that, again, you can share with members of your club or with other people that are interested in long-term fundamental investing. Next slide, please. So why do we do this? Well, we believe that we can show you how to use the resources of the magazine, and for the resources that are up on the website, there's a free 90-day trial if you're not already a BI member. That's where that hyperlink is. And we focus on how to use our form, the stock selection guide. Sometimes we talk about the PERT report, which helps us in terms of doing portfolio management. We try to show you the best practices of long-term fundamental investors. This is something that we do with both the Maryland chapter and the DC regional chapter. We want to promote our 2 model clubs and also the Club Connect program, and to be able to be part of the Mid-Atlantic. You do not need to be a member of BI to be here, nor do you have to be in Maryland, DC, or Virginia. I see there are people that are outside this area. Glad to have you. There's no requirement of that. This is just how we sort of build our community. But this is the work of the people of Maryland, DC, and Virginia to get us going. Next slide, please. So in just over an hour, we're going to go over 4 stocks. 2 of them come from the member-only magazine called the BI Magazine, the Stock to Study an Undervalued Future. And then the others have to come from either the magazine or the website. Tonight we have one from First Cut, and we have one from Ticker Talk, which is the 5 and 5 program. But generally what we're showing you is that there's a lot of excellent stock ideas that you get at either the website or the magazine that you can get as part of your membership. Next slide, please. So for those people that want to be able to see in advance the stocks, I see I have this highlighted on Brown and Foreman. It actually should be the one down below it, Paycom and Weston. That was announced back in July. Cognizant and Brown and Foreman will be next month's presentation. You can see this, the Home About Us news releases. You don't have to be a BI member. Anyone can see it. And like I said, you can already see what the November presentations are. That's what I've highlighted. Next slide, please. So if you are a member of Better Investing, there is a way to be able to get this stuff in advance. And you can be able to do that if you go where that red circle is up in the top that with My Account. When you click on that, you want to go to where I have the green circle on the left-hand side with email and product subscription information. That will open up the window that's over on the right-hand side, and you can be able to sit there and get information on your local chapter news. That's where I have that arrow pointing. But before you hit the Save Changes, and you have to hit Save Changes for it to go through, is see where I have that yellow highlight with the BI Weekly e-newsletter. If you're a BI member, you can get that. It comes from headquarters, and there's a lot of great resources there. Then hit Save Changes. Let's go to the next slide. This is what that weekly newsletter looks like. It comes out at the close of business on Thursday. It's just for members. It highlights some of the education that's going on, as well as some stock ideas and also some research, some of the first cuts that are coming on. This one they're doing, I think, later on this week. I think it's on Thursday. They're doing completing a stock study on Paycom, which is actually what Ken is going to be presenting later on tonight. But you can be able to see some of the resources, the blue arrow down at the bottom. There's some new updates to the SSG Plus for us as members that we can see, and just a lot of great resources. Sometimes it can be in your spam email, so if you signed up for it and you're not getting, check your spam account. Next slide. So we're also up on Facebook. This is sort of a joint page between the DC regional and the Maryland chapter. You don't have to be a BI member. You can get information there. We don't post a lot of stuff there, but it is a way to be able to find out what's going on. And again, to be able to reach out some of the non-members in our community. Next slide. This is what's going on in the Maryland chapter. Again, you can find it under our community. I have that highlighted in yellow in the upper right in the local events. So one thing that they have coming is they're having an in-person SSG class. It's going to be at the College of Southern Maryland in La Plata. So it's not exactly accessible if you're in Springfield, Virginia, or even in DC. La Plata's down there quite a bit. But you can't, if you want to do one in person, that's the way to do it. The national headquarters is doing an online one that you can find there. But if you feel like you want to get something in person, here's a way to be able to do it. Next slide. And the Maryland chapter just finished their portfolio contest, and the winner was win or lose. I don't know who it was. I came in third place out of 7, so I outperformed the S&P 500, but I didn't get all the way through. But this is something for people that live in the Maryland chapter, which is everything in Maryland except Montgomery County. It's free. You can do it as both a club or as an individual. They'll start it up again in January. So if you're in that area, please sign up for it. It's just good fun stuff to be able to talk about. Next slide. Cheryl, to you.
All right. Every month, except for December, the DC chapter puts out Money Matters Financial Education. And this month, it is going to be the corporate life cycle. So it's kind of like saying people have life cycles. They start out as babies, and companies also have a similar life cycle as well that they go through. And if you are a regular here, you've seen us do that at the very end of these events. But if you want to tune in, it is the third Tuesday, which is October the 15th from 7:30 to 9. And there is the web link for it. You just click on that where it says online, and you can go right to that podcast, and it should be very interesting. Next.
Ken, why don't you tell us about your club?
Happy Investing Investment Club was started in 2001. We currently have 7 partners. We meet on the third Friday of each month from 6:30 to approximately 9. We are pretty much an online club, and you like to contact someone about attending, you can reach us at digging.into.bi@gmail.com.
Okay, thank you. And Richard, why don't you tell us about your club?
Okay, good evening. The club was started in 2017. We currently have 5 partners. We meet on the third Wednesday of the month at online at 7, usually to 9 o'clock in the evening. Our education for this month is yet to be determined. We're still doing a final select on the stock study. It's going to be Paycom, Oddity, and ACMR. You can reach us at the email shown there. And that's about it.
Thank you. Bhaskar, why don't you tell us about your club?
So, Model Investment Club of Northern Virginia, McNova, we have been in since 2008. We have about 14 partners. It meets on the second Tuesday of every month. It falls tomorrow. If anyone wants to join, use that GoToMeeting link. Anyone is welcome to attend. Tomorrow, we are having an education segment on closer look at ROE, the return on equity, and other measures. Tomorrow's stock study is NOVA Limited, ticker NVMI. You can reach us at mcnova@dc.betterinvesting.net. Next slide.
Thank you. Cheryl, tell us about the Club Connect program.
Club Connect is a relatively new program, took the place of Meet a Club. And what happens is it's a little bit finer tuned, where you can hook up with clubs that are looking for partners, or as an individual investor, you can look up what clubs are available that are also looking for new members. So you can go to where it says new program. That's the hyperlink that will take you to the Club Connect. Fill out some forms, send them in to the email that is on the form, and you will be part of the program. And back to you, Kevin.
So this is digging into BI, so we like to be able to show you how you can be able to get access stuff rather than waiting just for the post office. You can get it as both an e-magazine, or you can also look at it on your phone or tablet or laptop through the app over on the left-hand side. In fact, you'll see the app already has the November issue already up, and here we are, we're just talking about the October one. So you can already see that online. Well, I haven't looked in the last couple hours to see if we can find that on the BI website. But again, just a way to be able to get this out. I have this saying the August issue. This is, I always thought I edit this and I never get it right. This is the October issue and it came out in mid-September, not the August issue. Oh well, this is what you get for having volunteers do it. Next slide. So if you want to be able to get the online stuff, you can see the green arrow on the left-hand side, Better Investing Magazine for mobile devices, and follow the steps there. The red arrow, the analyst reports and other resources, that's the additional information that you can find for both the undervalued feature and stock to study for every stock that's there. They will usually say in the article that there's additional resources. that's where you can find it and to be able to get to it. So if you want to be able to get to the magazine itself, if you look in the center where it says View Magazine Issues, you'd click on that to go to it. Let's go to our next slide and we'll show them what they get. Well, one of the things we like to do is feature one of the articles that's in here. And this time I decided to look at Angel McQuaid's book value column. It's kind of interesting. She said, now that she's not in the active parenting phase right now, she has a little bit more time and she wanted to be able to sort of freshen up her approach to tracking her stocks in her portfolio. And she ended up seeing this person as a podcast and as an author called The Lazy Genius. So it's kind of interesting. So go ahead and take a look at that. Again, this is in the member section of it, but you can also just find this podcaster as well. If you just look at if you're on podcast, you can be able to check them out under the Lazy Genius thing. So kind of an interesting thing to take a look at. Next slide. So also at the end of the, on page 51, there's always the investor event stuff. This time, a lot of the stuff was already from September, but Puget Sound is having their big virtual investor education conference. It's going to be 5 different classes over 3 days, all free, all online. You just have to do things on Pacific time. So 8:45 Pacific time for here, us on the East Coast, will be just afternoon. Closer to 1, but you can see all the different classes that they have highlighted there. So take a look at that if that's something that you're interested in. Next slide. So we've done enough of the prep work. So here's what we're going to be doing. We're going to do our first 2 stocks. Actually, only one is in core. That's going to be Ken Williams and Paycom, the stock to study. And then Bhaskar has Schlumberger, which was a 5 and 5 in August. So let's go to the next slide. Let's have me stop talking, and Ken, you take it away and tell us all about Paycom.
So my stock for tonight is Paycom. Next slide. And it is a stock to study for the month of October in the latest issue of the magazine. And of course, with every stock to study, there's a nice article on the company to read. Next slide. So, a bit of a corporate overview. The company was launched in 1998 as one of the nation's first web-based human resources and payroll technology companies. It's a fast-growing provider of payroll and human capital management, or HCM. Software is primarily targeting clients with 50 to 10,000 employees in the United States. As of December 31st, 2023, Paycom was serving about 36,800 clients and stores HR data for about 6.8 million individuals. They're headquartered in Oklahoma City, Oklahoma. And if you had invested $10,000 5 years ago, it would be worth about $8,234 today. Next slide. You may have seen a number of commercials, their ads featuring the unnecessary action hero. I believe it's directed by the name of Shamar Moore. It's one of the ways that they advertise themselves to the public. Next slide. And I just trying to do some research on the human capital management market to get a sense of how it's growing. So according to some information I was able to find, it appears to be about a $15 billion market in 2018. They expect to grow to about $30.55 billion in 2026. It's roughly a compound annual growth rate of about 9%. It seems to address a number of different areas, BFSI, retail, healthcare, government, manufacturing, education, and others. And the market size in North America was about 7.27 billion in 2018. Next slide. So there's been a recent price drop in the shares of Paycom. Thomas, the chief operating officer, was appointed co-CEO to serve alongside company co-founder Chad Richardson. In May, however, Thomas stepped down, citing unspecific personal reasons for his departure. The Thomas announcement preceded a prolonged slide in the share price, which reached a 52-week low of $139.50 on July 9th. Richardson took up his former role as sole CEO. The company reportedly may be looking for a new CEO to take over for Richardson. An even steeper drop occurred almost a year ago when they launched a product called Betty. The product can be cannibalize near-term sales of their Paycom offerings to some extent. Issue appeared to have come to a head last fall. So this Betty product that they introduced essentially allowed individual users of their product to make modifications to their payroll information. Prior to that, if changes needed to be made, the company was charged a fee to make the changes. Well, with the introduction of Betty, those costs kind of went away, and they kind of shot themselves in the foot. In terms of the revenue, it definitely had an impact on revenue. So this drop that you see around November is the introduction of the Betty product. Next slide. So their growth strategy is to increase their presence in existing markets, expand into additional markets, enlarge their existing client relationships, target larger clients and capture incremental small business demand, maintain leadership and innovation by strengthening and extending its software solution. Next slide. So their software is ideal for growing businesses switching from a small payroll provider or firms that are hiring and want to streamline talent acquisition and the management processes, and also for companies with remote workers. Next slide. Their software is not ideal for small businesses needing just basic payroll and human capital management, and companies looking for customizable HR payroll software. Next slide. So some confirming metrics here, looking at Morningstar. The fair value of the stock is about $220 as of August 1st. And their capital allocation is exemplary according to Morningstar. And they have currently a 4-star rating. And then according to Manifest, they have quality of 86, which is very good, and their PAR is about 12.5%, which is pretty good for a medium-sized company. Next slide. Taking a look at the value line, we see that they have a safety rating of about 3. Over the next 18 months, they're expected to grow about 20%. Over the next 3 to 5 years, they're in the range of 19 to 31%. They don't have any outstanding debt. They're currently well below the cash flow line, suggesting that they're undervalued. They have a financial strength rating of B++, and an earnings predictability rating of 80. I should have moved the circle a little lower on that slide. That's my fault. Next slide.
5 minutes, Tim.
Okay. Taking a look at the CFRA report, they have rated as a five-star buy with a 12-month price target of about $185. 3-year growth rate is about 13%. And net fair value rank is about 4 out of 5. And they have a fair value calculation of the company of about $194.12. Next slide. I did try to look at competitors for Paycom, and I tried to look at companies that were of similar size. And where Paycom really seems to stand out is in the management comparisons. In the pre-tax area, the return on equity and debt on capital, they seem to stand out compared to their competition in that area. Next slide. I'm sorry. This is a slide for MDC Holdings. I didn't get that out of the presentation. Next slide. So I did what I did for the sales and earnings. I went with 11.3 and 11.5%, and I did that by just I relied on the overall sentiment of our members. And so in looking at the overall sentiment, I went with those figures from what I was able to see. Next slide.
Just a moment. If we go back to that, the annual report stuff, I forgot to take that out of it. That's from a different company as well, so ignore that too. Sorry about that.
Not a problem. All right, and then going to the backside, I used the trailing 12-month high and low PEs of 33.7 and 16.8 for the high and low PEs. And for the low price, it is the low stock market forecasted price of $139.40. Next slide. So this resulted in it being in the buy rating. Yeah, I'm just not seeing upside downside ratio here. Next slide. Yeah, I guess it won't show up here either. But my overall return that I was getting for this was 19.1%, which falls in the annual return range, a 3 to 5 year range that Value Line was also projecting. Next slide. So Paycom is a medium-sized company. I believe it's well managed with strong innovative software solution. It is undervalued as it's trading below its 5-year average. Its upside downside ratio is 11-to-1 with a trailing return of 19.1%. I believe it's a worthy candidate for your consideration. I think it's a unique opportunity considering recent events and changes in management and their recent implementation of their Betty product. One of the things that they recently stated is that they're looking to expand to even larger companies. So these would be companies that have employees in excess of 10,000 employees. So that would be a tremendous opportunity if they're able to do this in markets in the United States as well as the rest of the world. So that's a potential growth opportunity for them as well. Next slide.
Well, thank you
And
very much.
now we have Bhaskar, who will present Schlumberger.
Thank you very much, Ken. Bhaskar, take it away.
Okay, good evening all. I'm going to talk about Schlumberger. The ticker is SLB. This is a stock that I came across in Ticker Talk, most recently in the 515 program by Ken Kavula. Next slide. So the company, this company is, they call it as a global technology company driving energy innovation for a balanced planet. Basically, this is an energy sector company, and the industry is oil and gas equipment services. It's a large size company, making revenues over 10 billion. They have different disciplines or product streams, and they make money through different business strategies. As of 2022, it is both the world's largest oil field services company and the world's leader in the digital solutions for subsurface and surface engineering. It is based in Curaçao, Netherlands and Antilles, but it is headquartered in Houston, Texas. It has about 111,000 employees, originally founded in 1926. Most recently in 2022, they rebranded themselves and they are now called SLB, no longer Schlumberger. It is also mentioned in the Forbes Global 2000 ranked SLB, largest company in the world. Next slide. So what do? They provide a range of oil field services to the oil producers. They provide services for these oil companies to build their upstream operations, which primarily include exploration and drilling. They are paid by these oil and gas companies. They do several projects, and they provide equipments and consulting also to these oil companies. 80% of the revenue come from international, 20% from the US, and they are operated from 120 countries. If you had to look up for their competitors, Halliburton and Baker Hughes are the closest one. Next slide. So these are the different segments. The reservoir performance, which provides the principal technologies involved during searching and defining hydrocarbon deposits. They make about 19% of their total revenue. The well construction, which is their 40% of the revenue, which is majority. The segment offers products and services required during drilling and positioning of oil and gas wells. The next one is the production systems, which is like 29%. It provides real-time evaluation and monitoring services for production management to oil companies. Then digital integration is a new one that they are starting to expand, which is like currently it is 12%. This segment is a combination of the company's software and seismic businesses and offers asset performance solutions such as seismic surveys, data processing, and digital technology to its customers. Basically, this is their consulting wing, and they are providing different consulting services for these kind of oil companies. And they are also expanding into technology side, and they have partnered with Google, Microsoft cloud services to build some AI capabilities in their software. And they are selling this as a software as a service to various customers. They call it the Delphi technology, which is their software technology wing. The asset performance solution, APS, is the consulting wing where the different businesses allows well operators to completely outsource project management to SLB. Next slide. So their value creation is mostly through their innovation, especially in the modern technology, and through several acquisitions. If you look back, they have acquired several companies. The biggest one is Cameron in 2015. They acquired it for 15 billion, and Morningstar calls this acquisition as over-optimistic attempt to capitalize on expected recovery in offshore production. So this is one of the big ones that they acquired because it is adding a lot of value to their business. And this company, they are providing production oil drilling kind of service, and that is one of the important core function that they are using it for the business. And Champion X is another one which they early April they cut a deal, and it is waiting for the approval. There are no issues found, but it is waiting for the approval. They acquired this for 7.6 billion in common stock. Basically, that Champion X is a marketer for chemicals, artificial lift solutions, equipment and technologies to energy exploration and production companies around the world. These assets, they help to bolster SLB's competitiveness and profitable growth. And there is a smaller acquisition, which is Norway-based Aker Carbon Capture. They did it for 387 million. This addition enhances SLB's overall operating diversity. The Delphi platform, which is their software platform, is now in its third year of commercial deployment, and it continues to gain customers' trust with more than 125 contracts to date and 400% user growth since 2019. So this is their technology side, and this is where they are spending most of their innovation in creating and helping their customers with their software. Next slide. So analysts estimates, this is on the left side, Morningstar is categorizing it's undervalued, and it is selling at a 26% discount. The closing price is $45.46 on October 4th, and the fair value is $62. CFRA, which is on the right side, gives a 4-star rating and with a buy, and it is giving a 12-month target price of $59. Currently, it's selling at $45. The next one is a manifest investing. It is a high quality, obviously, for the high quality under this in this particular sector and industry, with a par of 20%. Next slide.
5 minutes, Bhaskar, 5 minutes.
Thank you. Going to the SSGs, this is the front page. This is, it looks, the earnings and the pre-tax looks a little odd. Looking back, I was looking at all the what happened between 2015, 2016 timeframe. That is the major acquisition they did in 2015 for 15 billion. The total revenue was 35 billion, and they acquired this for 15 billion at that time, which is like a big. And Morningstar, as I said, it had over-optimistic attempt to add this to their portfolio. That is the reason, but sales was just flat almost, and it was in the upward trend. 2019 and 20 is mainly because of the COVID. There were a lot of expenses that organizations started cutting, and for the obvious pandemics reasons. On the right side, you will see the estimates given by the ACE estimates. For the 2 year, they give 15%, and earnings per share is 14.5. Their sales percentage change was 12.8, and the earnings per share percentage change is 6.9. Next slide. Under the management, using the fundamental company data, I gave the forecast of sales forecast of 11% and earnings per share as 11%. I showed the ACE estimates is like about 15%. I used 11%, and the 5-year estimate is 59,223,000, which is close to what Value Line is projecting. The earnings per share comes to $5.16. Under the pre-tax profit, the trend you can see, most of them are green, which is recovering. If you ignore the 2019 and 20, which are in the negatives, it's all showing in the upward trend. So I'm not worried about that. The ROE and debt to capital is also in the right trend. Next slide. So looking at the P's, there are no meaningful figures on 2019 and 20. We can ignore that. In spite of that, the current P is under the 5-year average, which is 14.9, which tells it is undervalued and it has room for expansion. It is a dividend paying stock since 1971. They have been paying dividends. Up until 2019, they were giving $2 per share, but after that, it started slowing down for the obvious reasons. They are expected to come back to the $2 in 2025, late 2025, they will come back to the $2, which means they are growing. Next slide. Looking at the risk and reward, I gave the high PE estimate of 20 and a low PE estimate of 12. That brings the forecasted high price to $103 and the low price is 36.7. And it gives the upside downside of 6.6 to 1, which is in the buy zone. Value line, 18-month target price is showing between is $39 to $81. Midpoint is $60, and the 5-year projection shows as 115, which is 26% annual return, and the low of $75 with 14% return. My SSG shows as a buy. Next slide, please.
2 minutes, Bhaskar, 2 minutes.
Next slide. So final summary, this is a buy. The Schlumberger SLB comes out as buy for my SSG with a 6.6 to 1 and a total high PE return of 19.5 and the projected return of 14.7. Next slide. In summary, this is a large size energy sector company. SLB invests in research and AI technologies for using their Delphi software and for its continuous growth and competition. The recent acquisitions is to add to their portfolio and to increase the sales. SLB is a dividend paying company. One risk that was highlighted in CFRA is the exposure to the volatile crude oil and natural gas prices. Its dependence on the capital spending decisions by its oil and gas producing customers and the political risk associated with it, with the operating in frontier regions around the world. Because it is depending on the oil and gas, anything that changes could impact potentially, which is the risk that we in the CFRA highlights. Even Morningstar mentioned that. My SSG comes out as a buy with the upside downside of 6:1. If you prefer, you can consider Halliburton and the Baker and compare, and you can decide. That's all.
Thank you, Bhaskar. Appreciate it very much. We can go to our next slide. So now we're going to look at 2 and plus, although Bhaskar actually did his in there. We're going to look at Lamb and Weston, I should say, which is the undervalued feature. Rob's going to take a look at that, and then Brown and Brown, Richard's going to take a look at that he found in First Cut. So let's go to the next slide, and Rob, why don't you take us through Lamb and Weston?
Oh, doesn't that look great? Yeah. Who doesn't like a French fry?
I'm hungry already.
I know. So this was an undervalued feature in the magazine. Very good article. Used that for a lot of the research, understanding the company. And then it's also followed by all of our key buy-side analysts. Next slide, please. Okay, here we go. Let's see. In contrast, members of the Securities Review and Editor, I'm going to read this. The company enjoys several strengths. Long-term contracts, I was going to talk about that, with farmers in the high-yield, low-cost growing areas in the Northwest, providing a competitive advantage. Next slide, please. Really? Okay. This is different than I sent it to you. Okay. So who is Lamb & Weston? It's a consumer defensive holding in the staples packaged food industry. And I thought that since we only look at growth companies, we ought to think about what is a defensive consumer defensive holding. Investopedia says a corporation whose sales and earnings remain relatively stable during both economic upturns and downturns. So it provides consistent dividends and stable earnings regardless of the overall state of the stock market. Next slide, please. Okay. So it's the first time I'm looking at this slide deck in this form.
I'm sorry, I may have not put it in correctly, so I apologize for that, Rob.
I was wanting to go to the picture page, but let's look at the next one. We'll have to come back. No, that's way too far. Okay, we'll get to this. Okay, I'll just read it. So what I used for the SSGs was a projected growth rate for sales of 4%. That was based on analysts' consensus estimate and reinforced by the company projections also. So they the projected growth rate in earnings are 8.7. The PE ratio I used was 22.4, which is 10-year average on the SSG. Low price I selected was $43 because, which was I calculated 80% of the lowest stock closing price for the last 52 weeks. Since the stock price is so depressed, the SSG is very sensitive to low price used. If you put in $53, you're going to end up with a very large upside downside ratio that is overly high. Next slide, please. Okay, this is the PE history, the 10-year average. I took out the years in 2019, 2020, 21. So you can see the 10-year average was 22.4 for the high PE. Low PE was 14.5, but I calculated the low price. Next slide, please. Okay, one of my, this is a visual analysis from the SSG form. And my concern was this company just got spun off from ConAgra in 2016. And you'll see later I have concern about the debt level. They also spun off a lot of debt with it. So it's starting in you start in 2016, and then immediately what happens? The sales go down the green line in 2019, 2020, 21. But look how steeply the pre-tax profit and earnings per share line went down. So that's that profitability uncertainty is of concern. Next slide, please. Next slide, please. Okay, so I wondered why that happened, and I looked at the 10K filings and found that 19 didn't seem to be anything there, but 20, we know what happened in 20, COVID, and this is probably the most extreme example of the effect of COVID that I've seen. Then the losses in 21 were still due to the, what happened, all the recovery from COVID that we went through. 22, steep recovery, even in spite of the transportation costs. They also supposedly had a historically poor potato crop in the Pacific Northwest and constraints in labor availability. Then 23, improved sales and earnings with specific actions. They say pricing and supply chain productivity settings. The 24 now had a different environment. A softer global demand for their product and executional challenges. They implemented a new enterprise resource software program system, and it evidently didn't work real well, and it resulted in losing some customers actually. Like, I'm not sure. Yeah, a customer example would be McDonald's, which makes up 14% of their sales. So that raises a question to me about the management, but I'm willing to give them a chance to not do that again. Next slide, please.
5 minutes, Rob. 5 minutes.
Okay, so peers and competitors that I used. These first three MGP ingredients, Nomad and Simply Good Foods, are about the same size suppliers. I also use large food suppliers for Morningstar, Conagra, Kraft Heinz, and General Mills. Next slide, please. This shows the historical sales, pretty flat for all of them. Lamb, Weston, MG, PI, Nomad, and Simple. Okay, next slide, please. Here's the debt to capital. That bothers me. That was the debt that was carried over, or as part of the spinoff, but it's going down. That's the first line of the table. It was, you can see in 2016, it was 136%, but it's coming down. Next slide, please. And this is liquidity ratios. This bothers me when I see the standard liquidity ratios for our debt as less than preferred. Something to be considered. Next slide, please. So I ended up on my SSG. The upside downside ratio is 5.8 to 1. I'm looking at the right hand table. The total return of 24%, high PE, average PE of about 20%. That's pretty doggone strong. Next slide, please. And Morningstar comparisons, you can see that for Lamb Weston, they assigned a fair value of 95. The last close I checked was about 68. So if you want to buy, on a 50% increase, earning that or getting it, it might be something to consider. Next slide, please. I was talking about the 2 drops in the quarterly reports on the price chart. I was not. Now I'm showing it to you. And this is why it is now related to the enterprise resource program implementation. And now it's that's what drove it from 90 some down to 65, currently 68. Next slide, please. So conclusion is Lamb Weston's effectively performing company, doing a lot of things right. capable of significant future performance. It is in the buy range of my SSG, with the buy range ending at 74.60. It's a worthy candidate to consider adding to a portfolio if you are looking for a slow-growing consumer defensive holding with regular dividends. It paid, the last quarter, it paid at a 2.22% yield. They've paid dividends since spinoff and raised the dividends every year. You'll have to justify the red flags that I've shown you in the SSG, the sales and profitability dips in the COVID pandemic years. You know, it was a black swan, right? But that doesn't mean there might not be another one. The debt level, liquidity, the management implementation, and other commodity-based risk. We're talking about potatoes. That potatoes are grown like in the Pacific Northwest, in the Columbia River Basin. And I've been in Idaho and in eastern Idaho, and it is desert and mountains, except where the Snake River flows, and there it's agricultural. So now I can see the potential for agriculture in the West with the size and flow rate of the Columbia River. Next slide, please. Are we done? Yes, we are. I have an appendix which you can look at some additional slides. I wanted to let me just back up a moment and point out from a company standpoint, it's a very easy business model for me to get my hands around. You got potatoes being grown by farmers in a place that's perfect for it. And you've got a company that takes these potatoes and makes frozen French fries out of them and sells it around the world to quick service restaurants, to full service restaurants. It has contracts, long-term contracts with both the farmers and with the restaurants that they supply to. So I like to keep things simple and to try to understand a business model, and this is as simple as I've seen. Okay.
Thank you, Rich. That about concludes the time.
All right, I'm done.
Thank you, Rich. And again, it was tough because, Rob, because I somehow downloaded the stuff in the wrong order. Well, last but certainly not least, our cleanup hitter is Richard Aronson, and he's going to tell us about Brown & Brown Insurance. So go ahead, Richard.
Okay, good evening, and thank you, Kevin. Next slide, please. So Brown & Brown Insurance is listed as BRO on the New York Stock Exchange in the financial services sector. It's a medium-sized company, about $4.3 billion in sales. And as Kevin mentioned, I found it in First Cut. Next slide, please. For a quick company overview, next slide. The company is 84 years old, so it's been around quite a while. It's 500 locations around the world with 16,000 employees, 60% of which are shareholders. Next slide, please. Brown & Brown is an insurance agent and broker offering insurance products and services. They offer insurance primarily in the areas of property, casualty, and employee benefits by connecting customers with insurance companies. So it earns its revenue via commissions from insurance companies and direct fees from its customers. And it generally, and I thought this was important, has no underwriting risk exposure. More than half of its revenue is from its retail segment, and we'll talk about segments shortly, that provides a broad range of insurance products and services to entities and individuals. It operates primarily in the United States and has its highest exposure in Florida. Next slide, please. From the 2023 annual report, the CEO commented that they exceeded their $4 billion annual revenue goal, doubling it in the last 5 years. The business grew 10.2% organically, not including the acquisition revenue, and the total revenue growth is 19.1%. They acquired 33 companies in 2023 alone, adding approximately 162 million in sales. And they've added 300 million of new annual revenue, acquired revenue, in the last 2 years. So one of their biggest growth features is the acquisition of other companies. Their EBITDA is the highest in the industry at 34%. And this is curious what EBITDA was. It's EBITDA with a COVID adjustment, which I haven't figured out what it is, but that's how they present the data. They have $1 billion in cash flow from operations in 2023, up from 881 million in 2022. And it's their 30th consecutive year of increased dividends. Next slide, please. Their long-term performance and growth strategy, they've increased revenues every year from 1993 to 2023, excluding 2009. Revenue grew from 95 million in 1993 to 4.3 billion in 2023, at a compound growth rate of 13.5%. Net income increased from 8 million to 870 million in the same time period, a compound growth rate of 16.9%. So part of BRO's growth strategy is to continue growing their revenues from net new business, organic growth internally, plus the revenue from new acquisitions. In the last 30 years, they acquired 644 insurance companies. And they continue to improve their capital expenditures and cash flow management, and are also seeking to enhance their EBITDA margins. Next slide. As you can see, total revenues, EBITDA, cash flows from operations, all have been up nicely in the last 5 years. Organic revenue growth had a slow start in the 2019 and 2020, and they've improved considerably in the last 3 years. Their EBITDA margin has improved from 30%, now it's at 34%. Next slide, please. They have 4 business segments. The largest, 58% of sales, is their retail segment, which provides a broad range of insurance products and services to commercial, public, quasi-public, professionals, and individual insured customers. Their national program, 1.08 billion, which is 25% of sales, provides professional liability and related packages for certain professionals, a range of insurance products for individuals, flood coverage, and other targeted product areas. They may need that with the hurricane coming. The wholesale brokerage is 540 million, which is 13% of sales. That segment sells excess and surplus commercial and personal lines of insurance, primarily through independent agents and brokers. And last, the 4th segment is services, with 163 million in sales, 4%. Excuse me. Provides insurance-related services, including third-party claims administration and comprehensive management services. Next slide. Let's take a look at their competition. Next slide. There was quite a number of competitors that I found. The most common of the various websites were the ones shown here: Erie, Willis Towers, Watson, Arthur Gallagher, Marsh & McLennan, and AON PLC. They ranged in They range in size from medium 2.3 billion to 22 billion in sales, Marsh & McLennan. Next slide. So to compare it, I used the sales growth rate, earnings growth rate, percent pre-tax profit, percent ROE, percent debt to capital, and percent payout. And what I tried to do is to visualize it, make it simpler. If it was better, if Brown & Brown was better than their competition and the peer group, according to Morningstar, I gave it a green box. If it was worse than the competition, I gave it a yellow or orange box. So you could see that in the fundamental data and the percent pre-tax profit and percent payout, Brown & Brown led the as being the highest among the peers. And so it has, it stands out among the competitors that I found. Next slide, please.
5 minutes, Richard. 5 minutes.
Okay, let's take a look at the SSG judgments. So this is the front side. As you can see, it's nicely up, straight, and parallel. The red arrow is pointing to the current price is near the all-time high. So that's an interesting tidbit. I did use the projection starting point as quarter. You tend to do that when the previous years, when you're at least 2 quarters into the current year. I use the quarterly projection starting point. The Morningstar detailed data looks like it's on a downward trend, but it's compared to the annual data from the previous year, year-end data. So it's actually up. The third point is in that data, it shows a slight downward tilt. So we'll take a look at that. Next slide, please. Fundamental data all looks good. Percent pre-tax profit and the return on equity are good with a trend upward. Debt to capital shows a slight increase, 41.9%. It's acceptable for a financial services company, and BRO has the cash flow to support that level of debt. Value line gives them a financial strength of, it should show A. Next slide, please. Sales growth judgment. I collected as much data as I could find online. Not every analyst company provided all data out to 2028. So I averaged them vertically and then computed the compound average growth rate horizontally. So I had an average estimate of 10.2%. Historical was 11.6. Not a huge difference. Member sentiment only had 38 studies, so I didn't use it. So the average compound annual growth rate I have is 10.9. That's what I used. Next slide, please. The same approach I used for the earnings growth, except here I was also included preferred procedure, came in at 9.9%, which was a little low. I wasn't quite sure I understood that. But the compound annual growth rate over the 3 data points is 12.9%. Next slide, please. The high PE, if you look at the 5-year average high PE, the current price over trailing 12 months earnings, and the current PE are all just about 30. So that was highly consistent. I also looked at the 5-year and 10-year average, and it was about a 3.5-point difference. So I thought that might indicate that there was an expansion in the PE over time. So I decided to make my judgment at 32. Next slide, please. Low PE, 5-year average is 19.5. I decided to go with that, but when I calculated the low price of $67.90, it was 34% below the current price, which I thought was rather extreme. The low price to be 80% of the current price relates to a low PE of 24. I decided to split the difference and make it a low PE estimate of 22. Next slide, please. So the high price, given the average high PE of 32, turned out to be $204 a share, high forecast price, and the low price came out to be $76.60, which is 26% below the current price. That brought us to an upside downside ratio of 3.7 to 1, definitely in the buy zone, and a potential price appreciation of 97%, almost a double. So I was quite surprised at the result. Next slide, please.
2 minutes, Richard. 2 minutes.
Okay, I think we got it. The total return was a high PE. With a high PE, it was 15.1%. Projected return for the average PE is 11.4%. So the other thing I looked at, if you recall, I mentioned I used the quarterly data projection point. If I just switched it to annual and kept everything else the same, I wanted to know what the difference was. And just a quick look, the upside downside ratio turns out to be 2.8 to 1. Somewhat lower, but not horrible. Total return of 12% and price appreciation of 72.8%. So it was an interesting way of comparing those two possibilities. Next slide, please. So in summary, Brown & Brown has consistent sales and earnings growth over the last 10 years and 30 years of continuous dividend growth. The firm has differentiated itself with disciplined capital allocation, supported by its growing cash flow. The risk-reward ratio is 3.7 to 1, and the compound annual growth rate is 15.1, including a 0.6% dividend. So I felt BRO is an interesting financial services company that stands out among its peers and is worth further study in your watch list. That's it.
Thank you very much, Richard. So here it is. We went through these relatively fast, maybe a lot quicker than you do if you were in your regular club. So what we like to do is we like to go back to our presenters and ask them sort of where it fits on sort of this life cycle between that shows up in our manual. So let's go to the next slide and we'll ask all of our presenters. So this is the life cycle. This comes out of the digital handbook, but it really dates back or harks back to T. Rowe Price when he wrote about this in 1939. That, and Cheryl mentioned this earlier, is that earnings for corporations pass through a life cycle just like a human being, where they have growth, maturity, and decadence. So Ken, why did you pick that location for Paycom in sort of the explosive growth but moving more towards the center? And are you
Paycom has moved beyond its explosive growth phase. Based on recent events where they've had some pullback in price as a result of their new product and their changes in management, kind of put them in the middle of the growth area. I thought that would be the best place for it at this point.
Okay. And Bhaskar, Schlumberger, SLB, why did you pick that location for it?
So this is an energy stock which has been in since 1926 and it has been growing. Recently, they are redefining their model as like a technology, and they are getting into the technology side of managing this thing. So they still are in the mature growth. They have room to grow even more. So that's why I picked that.
Okay. And Rob, with Lamb & Weston, why did you pick that location for Lamb? I say Lamb & Weston, Lamb Weston Holdings.
Yeah, it's certainly mature, even though this division was formed in 2016. The company, ConAgra, has been around for 70 years, making, when they, at least the French fry part. So I thought it was mature and slow growth. So it's, but I wanted to keep it inside the circle from an investment opportunity.
Okay. And Richard, tell us why you picked that location for Brown & Brown.
It's a growing company. It's obviously a medium size at $4 billion. I think it's past its explosive growth, if it had one. And I think it's just beginning a mature growth cycle, which still has plenty of growth left in it.
Okay, so you've heard all of us. We've given you sort of an overview of where we think things fit. Let's go to our next slide, and I think it's time for everyone to vote. Now, again, we're not necessarily saying pick the one that you think has the best upside downside ratio. We're asking you which one of the presentations interests you enough that you want to do further research of your own. Remember, we're looking for you to do your own research rather than to be able to do ours in it. So here are the 4 choices, and we can take a look at it. Maybe we'll do like manifest, and we'll also add in a none of the above. But overall, we can see how things are going. Let's see. All right, we've got about 40 and now 50% of you voting. The votes are coming in. It feels like what we'll be doing in a month from now. We're up to 65%. Those stray precincts, maybe we have some early votes that already came on in. We're at 73%. Can we get up over 80? We're getting close to 80. This is a good response, folks. Let me see if we got 1 or 2 more that there we are. Now that we're at 81, let me see if we can get all the way up. See if we can get 1 more to like 85. 1, 2. I don't think so. I think we can close it out. It looks like it's staying really slow. So go ahead and share the good news. So, Richard, you are the big winner with Brown and Brown. Congratulations. With that, Richard, because of that, that means you get to be able to do another presentation. We'll bring you back. How's that? Anyway,
I'm excited.
I can tell. Just keep your enthusiasm down there. Anyway, we do have some questions from the audience, and I sent everyone sort of the panelists, I sent you a thing. Take a look at some of those. Kent, do you want to sort of walk us through some of those questions and sort of divvy them out to whom you think they're being discussed to?
Certainly. Rob, Richard asked if, and you had talked a little bit about red flags in your presentation, but Richard asked if the sales growth is 4%, but the earnings is 8.7%. Does that indicate a red flag to you? That was the question, and I think there's also a question about why the earnings per share long-term estimate is 0%, and I'm not sure that's Lamb Weston or another one. So maybe we'll let Richard ask that question a little bit later.
Okay. Okay. I've been doing these for 10, 12 years, these SSGs. So I'm not a novice. I used to have hard and fast that the EPS growth had to match, could not be much greater than sales growth. But I've come to be more flexible. You can certainly use a preferred procedure and change some conditions and get a different answer there. So I used what I used was because of the Morningstar ACE numbers and the companies, which didn't end up in a slide deck, the company's projection. Let's see, that was, what did they say? They said net sales growth long term, low to middle single digits, and adjusted EPS, high single digits, driven by flexible capital structure and execution of the company's capital allocation strategies, including share repurchases. So looks like the company's paying attention to that too.
And Patricia also points out that Lamb Weston also grows their potatoes in Canada, not just Idaho.
Yes, they do. That was another slide you didn't see. Where around the world? It's let's see, where was that? That's in Alberta, Tabor.
That sounds.
Yeah,
that sounds right.
They have manufacturing facility are there as well.
All right, and then Richard, I think Richard has the question for you about why, and I didn't catch this, why the EPS long-term estimate is 0%. And Richard, I think I'm going to have you,
That
Richard
was
Anko, I
actually
think I'm going to have.
that was actually in Brown and Brown. Cheryl, can we go back to
Right,
slide
yeah.
nine? Can we go back to slide 90, 90? And that will help. And Richard, we can unmute you so that you can be able to talk about that. Let me make sure that you're unmuted so we can get you conversing with us. Okay,
Yeah,
you're muted on your side, Richard. So go ahead and hit your microphone on that. And let's go to slide 90, Cheryl. Right now, we're seeing the results of the quick poll.
Lou.
Hey, Richard, how are you?
There you go.
This is what you're talking about, where you see the long-term at
I'm
0.
looking at where the analyst consensus estimates shows an EPS long-term estimate of 0.0%, but I didn't. All the other numbers that I saw after this were different numbers than that. Where did this 0.0% come from?
that's an analyst consensus estimate. I could not figure out where it came from. If I looked at the 3 data points there, they weren't consistent. So the short answer is I don't know. I just tended to ignore it. I didn't think it was a valid 0 growth on the earnings per share.
Yeah.
Richard,
Yeah,
what happens
it could
is,
also be a data error. So.
yeah, if you sit there and if you pull down a Brown and Brown on this, and you look under I think data detailed estimates, you can see that they give 0, but it's because they don't list any ones there. They don't list any in there. So you can find data from Value Line or some other places to be able to plug in your future estimates. And where Richard has that red circle for the earnings there for those 3 dots, you can override that and put in different ones that you wanted to on in the visual analysis that he has the arrows pointing to.
Yeah, I actually.
Sorry, go ahead.
Yeah, the circle. I have feedback. That's what's annoying. The green circle and the blue circle that are to the right, 2028, are actually my estimates for the sales and earnings growth, where it ends up. So you kind of can see that they are relatively close to what Morningstar has early on. And it's just that 3rd data point that sort of is a little wacky.
I find it interesting. I was asked by my club, which is the Blue Chip Investment Club in Virginia Beach, in the Hampton Roads area. Well, we're part of the DC overall DC club. Anyways, I had gone to the Better Investing heat map to look at possible studies, and Brown and Brown was one of the ones that I had considered, but I eventually did one on Fastenal and presented it to my club. And Fastenal is much like Lamb and Weston. It's in a way. It's a slow grower over a long period of time.
Okay. Well, thank you very much. Any other questions, Kent? What else we got there?
I am not seeing any more. I think we've got, oops, all my questions just went away. Not seeing any more at this point. Yeah, nope, we're all good on questions.
Okay, let's go back to, I don't know, let's see what slide that would have been. We want to get back to where we were, so let's go to slide 102. There we are. And there's a picture of many of us that were at Bink that are doing some of the presentations. In fact, I see several of them are in the audience if they're not making the presentations themselves. Thank you very much. Ken, you and I are in every one of these photos, so we just are everywhere and the like. But here's where you can reach us for digging into the BI. And if you want to be able to reach the Maryland chapter or the DC regional chapter, there's the contact information for us there. Next slide, please. And if you, Cheryl, you want to take this one?
Okay, we have a mailing list. You go on to the DC chapter on the homepage for our chapter, and you can see a button there for joining our mailing list. Just fill it out and send it in, and we will be glad to add you to our mailing list that tells you about all the different events that we discussed at the beginning of this program, as well as events we add on. And we'd be glad to have you there, and to the club that is out in Virginia Beach. Love to send a director out to you to do a club visit.
Okay, let's go to our next slide. Kent, tell us all about how you want to volunteer.
Well, all righty. As Kevin mentioned at the very beginning of this event, everyone who's participating in this event is a volunteer. So as well, all of the chapters are entirely run by volunteers. And these folks really are the lifeblood of how Better Investing operates as a nonprofit corporation. But we would really like to have you participate as volunteers in your chapter as a director or volunteer. And the benefits of that is that you get to pick up some new skills. You can do teaching, you can do administrative work with the chapter, doing bookkeeping, or just managing web pages. That kind of thing is always very helpful.
You could do a presentation for digging into BI.
And as you could, yes, that would be really good, especially on some of the new stocks that are coming out, or some of the stocks that have been presented before. That would be wonderful. But one of the benefits of having that happen is that you can you can get the complimentary subscriptions to the online data feed from Better Investing, as well as discounts to the Better Investing conference, training programs, and substantial discounts for the Better Investing tools. So thank you. Next slide, please.
And so here's the stuff that's coming up for next month. It's going to be November 4th, the day before our elections. The two featured stocks are going to be Cognizant and Brown and Foreman. And we have two more to be determined. In fact, as we were doing this, I reached out to some of the people in the audience, and Helen and Richard both said that they'd be willing to help out. So I've given them my phone number so we can reach out. Helen used to be a director in the DC chapter, and Richard, as you just heard, is down in the Tidewater area, and we'd love to be able to feature Blue Chip and let them and hear what's going on with folks there. So I've given, you can reach me at the Digging Into BI, or you can also sit there, and like I said, I gave you my cell phone so we can talk afterwards. But that will make our 26th and 27th different presenter this year. And that's really how this thing works, is that we all get together and help each other out. So thank you, Helen and Richard.
Has a need of helping with putting together a presentation via PowerPoint, would be glad to help them on that as well.
Cheryl, what are you? You a PowerPoint ranger? Is that what I understand? Is that what I heard?
Yeah. Department of Defense. I am a PowerPoint ranger.
Very good. Well, thank you all. Let's finish up. And Kent, do we have any more questions, or did we take care of everything along the way?
I am not seeing any additional questions, so I think we have everything taken care of.
All right, let's keep moving along here. So we also put stuff up on Manifest Investing Dashboard. I actually haven't done it for a couple months, so I need to update those things, but you can be able to see stuff for every year. with November, that will be this will be the start of our four complete years that we have done. And it's all because we've had volunteers from all across that have some connection to DC, even if they've left like Kent and decided to go down to Alabama because he likes to be in the Hurricane Alley instead of being safe here in Baltimore. We understand. But you can find stuff here on Manifest Investing, the different dashboards to be able to track things. Again, you don't have to be a member of Manifest to do it. And if we go to the next slide, you'll see the hyperlinks for all of them over there too. So again, make sure to download the handouts. You can share that with these. And again, these blue underlines will get you to those exact locations so you can be able to see them. Next slide. And here's our final slide. And again, that's where you can find us on YouTube, that blue underline. That's the YouTube channel for us. Do we have any more questions, Kent, or anything that we're missing, Cheryl?
No, I'll leave it on for about another minute or so, just in case people hadn't had an opportunity to download the handouts yet.
Okay, very, very good. And Richard, if you want to, you can call me right after we're done here. I see you have a question in the chat. We'll be able to take care of that. And again, thank you for getting Blue Chip involved. We'd love to have that. So anyway, thank you very much. If we back up the 2 slides so we can see what the stocks are for or 3. There we are for November. There we are. And again, thank you very much. Join us on November 4th when we get together again to dig into the November issue of Better Investing. Thank you very much for being here, and we'll see you next month. Good night, all. Thank you, presenters.
And panelists, don't forget, just leave. Do not end it for everyone.
Yeah, it looks like we only have a few people sitting there.
Yep.
I'm going to jump off and I'll leave you this.
Okay. Non-attentive, that's wrong. I haven't. Okay, since they're not attentive, I will just end it all.